I mean, in my life, I've never seen anything like silver because it has so many utilities. The folks in Canada trying to push it towards a strategic metal rather than an industrial, and I think it should be. If you take the fact that you have these stupid commercial banks that have been short massive amounts for years, rendering silver the asset on the COMEX that has the largest concentrated short position of any commodity traded on the entire exchange. You take that out of the equation, and yeah, silver should be way higher. But I think in the face of rates that are positive against the CPI anyway, a real return, seeing gold move higher is a very bullish sign as far as I'm concerned.
In a recent interview with Arcadia Economics, Andy Schectman, CEO of Miles Franklin, asserts that silver offers an unparalleled opportunity for investors, what he terms asymmetrical risk reward. In addition to its role as an investment, silver serves as a strategic metal with a broader array of industrial and medical applications compared to gold. According to a report by the Silver Institute, demand for silverware is projected to increase by 9% this year, with jewelry demand anticipated to rise by 6%, driven primarily by India's expected surge in silver jewelry purchases. Additionally, the anticipated recovery in consumer electronics is poised to provide further momentum to the silver market. Despite short-term constraints on silver prices, many analysts suggest a potential turnaround in the latter half of 2024, coinciding with widespread expectations of interest rate cuts by the Federal Reserve. One of the famous analysts, Keith Neumeyer, had previously forecasted a triple-digit silver price, drawing parallels to the market cycle of 2000, when the dot-com bubble was at its peak and the mining sector faced challenges. Neumeyer believes it is only a matter of time before a market correction occurs, akin to the corrections witnessed in 2001 and 2002, leading to a significant rebound in commodity prices. Another renowned analyst, Michael DiRienzo, executive director of the Silver Institute, has expressed optimism regarding silver's performance this year, particularly on the demand side. He anticipates the price of silver to reach $30 an ounce, which would mark its highest level in 10 years. Addressing the discrepancy between the limited supply of above-ground silver and the escalating global debt, Andy highlights that commercial banks have suppressed silver's true value with substantial short positions on commodity exchanges like COMEX. Notably, certain banks on the COMEX engage in illegal short selling of silver, exceeding their position limits and exerting downward pressure on silver prices with each short sale. The growing physical demand for silver will eventually end long-standing market manipulation, leading to a surge in silver prices. We will present clips from Andy Schectman's interview with Arcadia Economics. But before we do, if you want more videos like this, please hit the subscribe button and turn on the notification bell for more updates. Thank you and enjoy the video.
There's the phrase asymmetrical risk reward. And it basically says, what is the asset that I can own that has the lowest downside risk and the best upside potential? I mean, in my life, I've never seen anything like silver, because it has so many utilities. The folks in Canada trying to push it towards a strategic metal rather than an industrial. And I think it should be a strategic metal. It is needed in so many capacities, and even in things that the military industrial complex uses that really isn't even openly counted on the supply demand fundamentals from the Silver Institute. So from military to green to digital, the need for silver is massive. And then the monetary aspect that people have awoken to over the last 3 years, largely in thanks to people like yourself who have woken up the public to the value, this asymmetrical risk reward that, the old statement, markets can stay irrational longer than you can stay solvent. But I'm not sure on this, but I would say approximately, let's say there's 100 billion or less in silver above ground, right? I mean, somewhere in that neighborhood. We're accumulating that much debt right now every 100 days, or excuse me, every 10 days, a trillion every 100 days, 100 billion every 10 days. So when you talk about how much money is out there versus how much silver is out there versus the need for it and the real potential in investment, if you take the fact that you have these stupid commercial banks that have been short massive amounts for years, rendering silver the asset on the COMEX that has the largest concentrated short position of any commodity traded on the entire exchange, you take that out of the equation. And yeah, silver should be way higher. Now, I guess the bottom line is that you can only manipulate any market over a very long period of time by pushing it in the direction that it is going. And I think the difference between the markets we see now, Chris, and the markets that we've all lived through is that for the very first time in my career, 34 years, I think there is a big push globally to accumulating assets, commodities. It used to be dollars and treasuries and stocks and real estate, but that's an environment that I think it has cycled and is moving the other direction as commodities and tangibles are moving into a bull phase at a time when, you think about it for a moment. You got mining eviscerated, exploration eviscerated, you got sentiment at the lowest levels. At the same time, you got sky high deficits and massive debt and all of the issues that we see around us that we talk about geopolitically and politically and socially and morally. The contrarian side of things would say there's never been a better time to jump head first into silver. But like I said, the market has a way of staying irrational longer than we can all stay solvent. But from a standpoint of logic and mathematics and economics, I don't know that there's a better place to be. So, yeah, have strong fingertips, hang on, because I don't think I've ever seen a better opportunity in my life, in my career, a better opportunity of asymmetrical risk reward, lowest downside, best upside. And I don't think there's even a way to shoot a hole in that, at least in my logic.
The traditional correlation between gold and bond prices, historically driven by rising bond prices and falling interest rates, known as Gibson's paradox, sees a notable departure. Andy observes this shift as bond prices decline and interest rates rise, yet gold continues to perform well. This deviation marks a fundamental change in the relationship between these asset classes. Despite real positive interest rates, gold's resilience and its breach of all-time highs indicate a significant valuation breakthrough. Andy believes that with no apparent resistance, gold could reach the $3,000 mark, as forecasted by Bank of America. In early trading Tuesday, gold prices surged to a new all-time high of $2,141 per troy ounce, up roughly 5.6% in the past month and 16% in the past year. Despite reaching unprecedented levels, Andy observes that there hasn't been a significant influx of sales, challenging conventional market wisdom. This suggests that investors may hold on to their positions amidst bullish market conditions. The surge in gold prices may be attributed to old-fashioned monetary policy. However, the exact reason behind the surge is not easily extrapolated. Nevertheless, these market dynamics indicate a shift in investor behavior and perceptions regarding gold as an asset class, showcasing its continued strength despite diverging from traditional correlations with bond prices and interest rates. Let's get back to the interview.
What you're seeing now is that, typically we've seen gold and bond prices move in symmetry as bond prices were rising and interest rates were falling, price of gold was rising. And that's the Gibson's paradox, the inverse relationship between real interest rates and gold. But we're seeing it now diverging. And this is a big deal because, gold used to be positively correlated with bonds. And now we're seeing bonds falling and interest rates rising again, slowly, but, not the pivot that everyone was expecting. And yet gold is doing well in the face of real positive interest rates, at least if you believe the CPI. Bottom line is this is a big development for the price of gold. And now that it's busted through its all-time closing high, I mean, in terms of resistance, there is none. The sky's the limit. Now, are we going to get to those numbers like when Bank of America was saying 3,000, or is this the move up, the one that we've all been waiting for? But I think in the face of rates that are positive against the CPI anyway, a real return, seeing gold move higher is a very bullish sign as far as I'm concerned. In the last few days, it's been very, very busy. It's interesting, when the market moves up or the market moves down, there is interest. When a market trades in a tight trading range, it's very quiet. So it's been very busy. I've noticed a lot of our backdated items have been sold out, where the stuff that wasn't 2024 has disappeared. And so you're seeing the large inventory starting to thin out. And that's how fast it happens. So you get rid of the backside of your inventory. And now you have still flush in 2024 stuff, but all it really takes is one big thing where, what if gold spiked and silver spiked by 20% today, like we see in Nvidia and Bitcoin? Well, bang, it goes straight to the moon, $2,500 or whatever it is. In the span of 24 hours, the entire industry would be sold out. And I want people to understand that for 6 months now, or literally since Christmas for sure, anyway, 3, 4 months, you and I have been talking a lot about how premiums have come way down and it's been very slow, and I didn't quite understand it, but you can slowly see that that's changing by the backdated stuff all start to disappear. And what has been very flush for a very long time, at least 3, 4 months, could very quickly change, and we're beginning to see that happen, at least the backside of it changing, where we're not as flush with inventory as we have been for several months now. So yeah, it just a few cents, 10, 20 cents. We're seeing premiums on silver go up. We're seeing premiums on gold just rise a little bit. I think that's indicative of what we've seen so far, which is spiked up demand. And one interesting thing is that I haven't noticed selling. And you would think when you get to all-time highs, you got a whole bunch of people who bought gold, even in 2011 at almost 2,000 an ounce, and recently, as we've hit all-time highs, we're not seeing that influx of selling that some pundits would say would happen when you get people have been hanging on for a long time and just want to let go. We haven't seen that. So I don't know. I think that if things continue the way they've been over the last few days, where gold's up over $100 in the last 2.5 trading days, you'll see things like, I think, really start to change in terms of premium.
Silver's recent bullish breakout on the monthly chart and the presence of bullish signals across various time frames suggest the potential for a significant price surge, with targets set around 27.14. This could indeed signify a shift in silver's trajectory, potentially fulfilling the long-awaited expectations of bullish investors. The possibility of silver breaking through previous multi-year highs adds further credence to this optimistic outlook. Share your thoughts on Andy's prediction in the comment section below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Thanks for watching.